Wanted to unpack what we've seen on Wall Street. First of all, closing out its best week in 3 months on Friday. You really get the sense here that investors are encouraged that central banks globally are on a course to cut rates now.
Good morning, Dan. Good to be with you. Yes, I would agree. I think the backdrop for monetary policy is actually fairly benign for risk assets, and the macro backdrop itself, with growth still pretty robust, but inflation actually, grinding lower, is actually a pretty good sweet spot for risk assets to remain pretty robust.
So walk me through the strategy. What will this shallower rate cut cycle mean for your portfolio allocations?
Yeah, so, even though I'd say that fixed income yield levels, all-in yield levels are quite attractive and interesting compared to the previous cycle, the key thing to realize is that we're in a very different economic regime now, post the pandemic, given all of the stimulus that went into the system and a lot of exciting activity in terms of productivity enhancement, which means that we can grow with strength, but without the heat, meaning without overheating and generating inflation. That backdrop means that risk assets should be the focus of your portfolio. We would be moderately leaning into risk at this stage and owning some bonds for downside protection. But this is a time to actually be focused on areas where you can find attractive earnings growth. And we would still say that that technology sector is the place to be for that.
Okay, you're not concerned about valuations, though? That sector looking pretty stretched, particularly given the gains that we've seen in those mega cap tech stocks and the chip makers like NVIDIA, for example.
Very good point. So we don't like the broad indices to get that exposure. And so our approach, our strategy has been very targeted. The technology is a very large sector. When you combine it with communication services, that sort of greater tech sector accounts for about 40% of the S&P 500, and it's not just those mega caps. And so you can find pockets, areas that have not been participating as much in the froth so far, and so there are pockets where you can still find value even within these areas of technology.
Indeed. So just to unpack other parts of the strategy here, I wanted to take you back to some of your comments about Treasuries as well. You say you've avoided owning US Treasuries since they cross below 4%. Even at current yield levels, we find the risk reward less compelling. Can you expand on that, particularly as we look at the central bank regime and this new environment that you talk about moving forward?
Sure. So this is an environment which exhibits a higher neutral level of interest rates. So we think the yields will settle into an equilibrium that is relatively significantly higher than the previous regime. What that means is the prospects for a significant fall in yields, which would obviously support bond prices, is fairly restricted. And so that's why the upside potential from bonds is not very interesting at this point. And that regime is really being created by an environment, as I said, where productivity is improving quite substantially as we see companies look to enhance their efficiency and take advantage of ways, not just to take advantage of generative AI, which is an area of excitement, but also automation, different forms of augmented reality and virtual. There's a lot that they can do to improve their profitability. And all of that means robust economic growth without inflation, and that limits how far bond yields can fall. That's why we think that bonds are okay in terms of the carry, the income that you can get from them, but the prospects for any additional return is quite limited.